Good afternoon, everyone. We're going to go ahead and get started. My name is Michelle Nelson, and I'm the social media content specialist here at Field Routes. Thank you for taking time out of your day today to join us for Get Ahead of the Competition, Prepare for Your Future Today. Joining us today is Palmer Higgins, CEO at Mainely and founding partner at Chenmark. Before we begin, I'll give you just a bit of background on Palmer. Palmer Higgins first entered the landscape and lawn care industry when he and two family members purchased Seabreeze Property Services of Portland, Maine in 2015. Since then, the three have acquired several more companies, including Mainely Grass, where he took over as CEO in 2019. Higgins and his team have completely transformed the business over the last 4 years, reimagining everything from planning and logistics to service offerings and reporting. His primary focus has been training and education, which not only became one of the company's 3 core values, but also served as the foundation on which the knowledge base and customer service level, which needed to serve 10,000 plus customers across 3 states, was built. We want to welcome you today, Palmer.
Thank you very much for having me. Looking forward to the talk and really excited to get into it. So let's do it. I'm going to share my screen here. Michelle, you want to just give me the heads up that you can see it? All right, perfect. So welcome to the session here. Thanks a lot for joining. My hope here with this session is to demystify the idea of selling your business, if that is of interest. Presumably, if you're here, it is. Disclaimer at the outset, though, that this is definitely going to be considered a Cliff Notes version. The presentation I have here is just about 11 slides. And in those 11 slides, I'm going to attempt to tell you what you need to know at a high level. But there's plenty under the hood. So please feel free to ask questions. If you type questions in, Michelle will jump in with your questions, and we should have plenty of time at the end to answer any questions you have. Also, like any industry, there's some jargon, and I'll use some, and I will try and explain it as I go along, but don't be afraid to ask. There's jargon in every industry, and the world of M&A is no different. So let's get going. First, just a little bit of background on Chenmark and what Chenmark is, who we are. Chenmark was a company that I founded with my brother and his wife, my sister-in-law, with a goal of acquiring small businesses, typically from owner-operators who were looking to retire. And when we acquire those businesses, we expect to own them indefinitely. And we also expect to retain all employees post-transaction. So when the businesses we are looking for good businesses that have been around for a long time, that we feel confident will be around for a long time to come. And then we support those companies with management if needed, and a team of shared services people here at Chenmark HQ in verticals like finance, technology, HR, marketing, to help serve the business that we've acquired and help it continue to be successful. And so, like the intro said, we've done a number of acquisitions, a few of them in the green industry, some outside the green industry. So familiar with the world of small business and small business acquisitions, and that's what I'm hoping to convey to you here today. So we're getting right into it now. This slide is about transition options, and important to note here that we're titling this slide specifically transition options, not transaction options. And the difference there is there are opportunities to sell part of your business, whether a minority part or maybe a majority part, but not all of it, and stay on after that transaction, in which case you will not be transitioning out of your business. This presentation is more focused on a transition out, but there are ways to sell a piece of your business and stay on. When it comes to full transitions, 4 options here to consider. transfer to within the family, kids or relatives. I won't go through exactly the reasons and questions, but a high level benefit here is you're keeping it in the family. There can be tons of flexibility around how that happens, when that happens over a period of time. The key questions there are going to be liquidity, and that's a financy type word of just meaning cash in your pocket, and family members' interest, obviously. Another option, management buyout. So this is going to be taking your business, selling it to one or a small group of key leaders in your company that are eager to stay on and have the wherewithal to continue to run the business. Can serve as a very easy option to transition out of the business for you. Can be very, very easy on stakeholders. So employees, clients, key vendors or suppliers. Can be an awesome way to reward your senior team that maybe has helped you build the business and has been with you for a long time. Questions there are going to be financial capability. If you're looking for a lump sum or substantially most of the business transaction coming over to you in cash, it can be difficult with a management buyout, not impossible. And how it gets structured, especially if there's multiple senior team members coming in the transaction, structure can be a question. A third option, not as common, but a well-trodden path because it is a government program. It's called an employee stock ownership plan, also called an ESOP, if you've heard that term thrown around. Very strict definition about what qualifies and how to go about it, but because it is a government program, it comes with some very, very favorable tax breaks associated with business taxation and is an opportunity to sell your business to your employees. So it's a little bit like a management buyout on steroids where you're selling to everyone and not just a select group of people. Downsides there, definitely complex because there are a lot of boxes to check and you have to be pretty regimented about how you go about it. And it can be quite a long process to accomplish in totality. And then the last is an outright sale. So this is going to be a sale to a third party that you may or may not know. Benefits there, most likely the most amount of significant cash upfront in that type of transaction. Generally a quicker transition out, although not always. The downside is going to be you probably don't know the buyer, and because the buyer doesn't know you, there has to be a more formal due diligence process, which is really just a phase of a transaction where buyer and seller are sharing information, seller typically to buyer, to essentially check to make sure that what the buyer thinks they are buying is what they are buying. Important to note across this whole, all these options, that there's no one right option. Whatever is right for you, your family, your team, your business, that is the right option for you. And there are people who specialize in each of these type of transitions who can help you think through the pros and the cons. So there are people, for example, who specialize in ESOPs. There are people who specialize in outright sales. There's people who specialize in transferring businesses within generations between parents and children. So there are people that specialize in all these that can help you think through the pros and cons of these options here. So next thing is questions to ask yourself as you sort of embark on this journey of thinking about if a sale of a business and a transition out of your business is right for you. I've shown a few up here. These are not the only ones, but first and foremost, definitely, do you want to sell 100% of your company? Do you want to roll post-close? Or are you looking to get out entirely? Are you open to alternative deal structures? So that would be not just selling all or part of your company, but are you willing to finance some of that transaction? Are you not? And are there specific specific deal breakers or key contingencies? Do you want to see certain employees stay on in certain roles? Do you want to make sure that your brand lives on? Do you want to, if you own real estate, do you want to keep the real estate and lease it back to a buyer? Do you want to sell everything? Those types of questions. And the point of this is really, you're trying to answer the fundamental question, what do I want, as specifically as possible? And important to note that again, there's no right answer here. I talked to a lot of potential sellers, business owners, and I think the perception is that being open to any and all options even if it's not what you really want, is what people think a buyer wants to hear. And I actually would flip it around. And the more clear you are on what you want in a sale makes it easier for a potential buyer, especially a third-party buyer, to look at the business, look at your business through that lens and try and get as close to what you want as possible. Because ultimately, no deal is going to get done unless both buyer and seller are happy with the deal and happy with the transition and happy with the structure. And I think at this point, we're going to ask our first poll question, which is, how long do buyers want sellers to stay involved in the business post-close? One year, 1 to 2, none on indefinitely. All right. So the reality is the answer to the question is neither. I sort of hung you guys all out to dry there. I'd say typically most sellers are looking to sell because they want to get out of their business within a year. And that is a very common sort of a maximum of 1 year transition out of the business is a very common transition. I will say I've seen all varieties. We've done acquisitions where the owner is out of the business within a few weeks. And we've done acquisitions where it's been multiple years. So again, really, it's whatever is right for you, what you're looking for. For sure, the buyer might have some opinions, but the extent that you have an opinion yourself, definitely I would recommend sharing that. All right. Very, very high level overview of the acquisition process here. Emphasis on brief in this slide. And I break it down into 3 buckets. Number 1 is value. How is value determined? The question that I'm sure is a lot on everyone's mind, what is my business worth and how is that determined? We're going to get into that a little bit, but establishing value and taking steps to highlight where value can be gleaned by a potential buyer is definitely a key part of a potential sale of a business. Who's involved? We're going to get into a lot of this a little bit, but I will touch on types of buyers is something that I don't have a dedicated slide for. I'll say super high level, a few types of buyers. You have what would be considered financial buyers. So if any of you have heard from people who have backgrounds in private equity, or if you've heard the term search fund, or you've seen a sort of an investor type, that would be considered a financial buyer. The other big type would be a strategic buyer. So that'd be someone who is in your industry or tangential to your industry and looking at your business as sort of some sort of strategic acquisition, whether it's to grow geographically or to grow into a service line or a competency that maybe you have that they don't have. Plenty under the hood there, but super high level. Obviously, your deal team, we're going to get into sort of who to think about to bring into your deal team. And other stakeholders, important to note, we're going to talk about this too, that it's not just your deal team. There's plenty of people on your side, be it your family, your business, your employees, your stakeholders that are important to at least consider in this process, even if they're not necessarily at the table with you. And then the final piece, we're going to touch on this in a lot more depth coming up here soon, is just the timing of a deal and when certain steps happen and when decisions need to get made. Again, purpose here is to educate you, the owner, on what to expect so you can start to think about planning. That is the goal here, is planning is what's going to help you in an ultimate sale. And I think we have another poll question coming up here as well. Poll question number 2. How long do you think it takes to sell your business? Less than 6 months, less than a year, 1 to 3 years? Nice, even split. So also, I could make an argument for all 3. Part of it is the preparation that you as a seller do on your end, and part of it is the readiness, the preparation, and the sophistication of a potential buyer on the other side. We're going to get into this right now, and I'll show you why. So here is a rough outline of the deal process with Milestones, and I'll walk you through each step. So we have today, the number one step, decision to sell. We have this in as 1 to 3 years. Huge range, totally get it. But the point here to get across is that there is significant time and consideration up front that you can do that will help you accelerate the actual deal process, which really starts with step 2 or 3, and deciding when you want to sell and preparing for it is going to put you in as good of a position as possible. Even if it's multi-years out, there are things you can do today that will help that rest of the process flow when that time does come. Step 2, selecting a broker. We'll talk about this when assembling your deal team, but a broker is essentially sort of a river guide or a quarterback to help you through the deal process, through the sale process. I'd encourage you, if you want to work with one, to spend time selecting one. You can, it's very common for businesses to work with a broker through the whole process, or work with them on a consultative basis if you're already working with a prospective buyer. Maybe a buyer's reached out to you, you're interested, but you don't want to go through that process alone. There are plenty of people out there on a consultative basis who will help you, guide you through that process. Step 3, marketing your company. So this is sort of the sale process of selling your business. If you don't have a buyer coming to you and you want to go find some buyers to buy your business, this is where you, either yourself or with a broker or with some sort of deal intermediary, will try and attract interested and capable buyers. We have this in at 1 to 3 months. I'd say the range could be even wider. It depends on the preparation that you've made to sell your business. And then where the real process kicks off is the initial conversation with buyers. And it's probably going to be multiple, but it's those initial conversations to familiarize yourself with buyers and for buyers to familiarize themselves with you, with the goal of trying to figure out if there's enough mutual interest to go on to step 5, which is an NDA. That is a abbreviation for non-disclosure agreement, which is really just a short legal agreement that says, we're interested. We're going to start getting much more specific information from the business, from the seller. And that information is confidential. It's trade secrets, it's financial information, it's org charts, it's employee names, it's maybe contract information. And so that's sensitive information that needs to be treated as such. And so it's a formal legal document that binds buyer and seller together, saying, we need to abide by a high degree of confidentiality here. And that sort of kicks off information sharing to evaluate if an opportunity or a deal is going to get made. And that generally results in what's called an LOI, a letter of intent. So that's another legal document from buyer to seller, outlining in some detail, but not in a summary basis, what a deal would look like. So it'll spell out valuation, it'll spell out structure, it'll spell out contingencies to closing. It's a little bit like an offer on a home, just a little bit more in depth. And the final piece of an LOI is generally includes exclusivity. So that kicks off a process where both buyer and seller say, yep, we think there's a deal to be made here, and we're going to engage exclusively in a negotiation process with the goal of finalizing a deal. And that kicks off step 7 here, due diligence, which is a fairly thorough deep dive into business information, essentially for the buyer to verify everything they think they know about the business, with the goal of finally closing a deal, which really just means signing a purchase agreement of some sort. And then you're closed. So there's huge ranges on all these steps, sort of by design. Timeframes vary widely based on your readiness, a seller's readiness to sell, and the buyer's sophistication in evaluating and closing a transaction. Just to give you a sense, Chenmark has closed transactions from, I would say, this stage 3 to all the way to closing in as little as 6 months. And others, it's taken 4 years, where initial conversation with a buyer happened, long pause in between when the fit wasn't necessarily right at that time, re-engaged 3.5 years later, and then closed the transaction about almost close to 4 years after actually meeting them. So huge range, but again, planning can help speed things up if a certain timeline is desired. So next is, all right, valuation approaches. What's my business worth? And there's sort of a caution here that valuation is not a science. It is definitely tempting to assume that because valuation often involves a lot of numbers, generally in a very pretty format in Excel, it looks very official, that there is a right answer to evaluation. And unfortunately, there is not. In the world of finance, there's often this debate of what certain financial assets are worth: stocks, bonds, derivatives, options. What are they worth? And there's a quip in that world, which is a world that I come from, that's sort of a little bit of a throwaway, but it's your business or an asset is worth what someone else pays for it. Until someone pays for something, value is just an opinion, and that is definitely true. But there are some ways that people value businesses that I think are helpful for you all to understand as you think about this. Number one is an asset-based approach. So this is valuing your business based on the value of its hard assets typically, but it can be intangible assets like brand. Fairly uncommon, to be honest, especially in the field service space. I'd say typically this approach would be used as sort of a minimum valuation threshold, and in some cases is used in more distressed companies. A much more common, by far the most common approach, is what's considered an earnings-based approach, which is the shorthand of which is determining a value of business by some multiple of the earnings that business generates. And I have a small box here, other approaches as revenue-based and gross profit. If you've heard businesses transact as a multiple of revenue or multiple of gross profit, the reality is those approaches are an earnings-based approach in sheep's clothing, but effectively trying to arrive at the same thing, which is what buyers are ultimately paying for, which is a future stream of cash flows. And how certain those cash flows are, how much they may grow in the future, that is what buyers are trying to ascertain, and that is what buyers are typically trying to acquire. Put another way, buyers are paying for what your business can do for them in some way. And it might do for one person something than it does for another person. And that's why valuation is not a science, and your business is worth what someone else will pay for it. Finding that right fit is what marketing your company and trying to find the right buyer is all about. So next, disclosure up front. This is a fairly heavy-handed way to get this point across. Nothing here is intended to take away from anyone's business entrepreneurial success. I've talked to a lot of business owners, and I have yet to meet one who has not overcome incredible challenges to get to where they are now. That said, unless any of these factors have led to a measurable improvement in your business, it's very hard for a buyer to justify paying for it. And so a way to think about that is, if you have two identical businesses, they're absolutely identical, but one is 30 years old and one is 20 years old, it's probable that those businesses are going to be valued similarly, unless the 30-year-old business can demonstrate that by being in business for that extra 10 years has proven some measurable value to a buyer. Either they are more likely to retain customers, or they have a better sales process, or they have a more robust revenue pipeline or something like that. Unless it can translate into something tangible for the buyer, these types of factors aren't gonna sway a buyer. The last piece about how big your company could be, my point to you all would be that if there are simple or easy things that you know would increase the value of your business, do them before you decide to sell. And the reason I bring this up is I get this a lot from potential sellers of, my business can be so big, it could be double or triple. All you need to do is X, and X sounds so easy. And the unfortunate thing is that any buyer's response is gonna be like, well, if that's easy, why, if it's so easy, why didn't you do it? And if it really is, you probably should do it, and you'll realize a really handsome reward for that. Deal team. So almost by definition, chances are, if you're in this webinar, you probably haven't sold the business before. You might not know even the first thing about selling your business, and that's totally fine. And there are people who are out there whose entire careers, whose whole jobs are there to help you do just this. And I'm going to walk you through some of the key components. I broached on one initially. It's a business broker. Two functions of business broker. Sometimes they're called investment bankers. Sometimes they're called deal intermediaries. Sometimes they're called deal consultants, but primarily serve two functions. Number one is marketing your company to attract serious buyers. And the second is to be a consultant to you during the actual sale process. As someone who's seen a lot of deals, they know what, they know what's right, they know what's normal, they know what to expect from buyers, and importantly, they know what's not normal and what's not appropriate and what's too much or too far. And they can be a very helpful resource for you in that process, especially if it's something that's totally foreign to you. If you have a short list of potential buyers, or maybe you already know who you want to sell to, and you don't necessarily want to market your business to a bunch of unknown third parties, you can definitely engage in a person like this to help you specifically through that negotiation part, the negotiation, the diligence, and the sale. But either way, having someone to help guide you through the process can be incredibly valuable. So you're not trying to learn all this for the first time when you're only going to be selling your business one time. A lawyer is your definite next most important person. It is possible that your lawyer can serve as your consultant. I haven't seen it a ton, but there are plenty of very capable lawyers out there who have tons of deal experience who can help guide you through that process as well. I'd say the most important thing is, even if you're not looking for your lawyer to be your M&A consultant, your sale consultant, it is very important to get a lawyer with M&A experience, and ideally with small business M&A experience. Transacting, selling businesses, then the relationship between buyer and seller, the legal documents that go into that, they are fairly particular. Once you get under the hood, it's not the world's most complex thing, but anything legal tends to get complex, and knowing someone who has been through it that you can trust is critically important. Again, for the same reasons that having a broker or a business intermediary who's been through the process before is going to be helpful. And finally, an accountant, probably going to be more so on your side and not so much facing the buyer, but selling your business is probably going to have some tax consequences, probably going to have some wealth management consequences. And so having someone on your team, on your side, that can help you think through how to manage that transaction, how to do so in a thoughtful way, how to limit taxes, how to prepare you and your family's livelihood is definitely very important and going to be very timely. And getting them set up with you ahead of time can be very helpful, especially if there are certain aspects of a deal that need to be checked off for you to accomplish what you need on a financial end. Other parties involved, this is more so on the buy side. There's a lot of different components. I'm only highlighting two here. There's definitely going to be lawyers on the buyer side. There's definitely going to be accountants on the buyer side. You may or may not interface with them. It's possible your deal team will interface with their deal team. But the two I did want to highlight are banks and equity partners. Basically, where's the money coming from? There are a few ways to basically fund a transaction. One very simple way is you find someone who's got money in the bank and they pay you that money. Very simple, in which case that person is serving as both the bank and the equity partner. In a lot of other cases, a buyer is going to be borrowing some money from a bank to help fund that acquisition. and they may or may not be raising money from third-party investors themselves, because they don't have necessarily the money in the bank to buy a business or to buy your business. And so understanding where the money is coming from the buyer can be helpful. This is also something a broker can help facilitate and help vet. But what you don't want is to go down the whole process and realize that the person you've been working so hard to get to understand your business and value it the right way, and someone you've probably come to know and like and want to acquire your business because you trust that they can take your business on and they can do right by your employees. Terrible to find out at the 11th hour that they don't actually have the financial capability to buy your business. So just a high level on what to expect on the buy side there. And I touched on this, that I was going to bring it up. Other parties is sort of internal. And again, this can be explicitly or implicitly involved in the deal. But I bring this up because I have yet to see a business that was not at least informally, at least a family business. And that is totally okay, totally expected. I'd even say feel free to loop them into the process to the extent that you see fit. I can tell you, I've had multiple meetings where I'm going in expecting to meet with the seller and I end up meeting with the seller and the seller's spouse. Totally fine, totally fine. It's also very common to be concerned about confidentiality of a potential sale with your employees. If some are critical to the deal, you may have to bring them into the fold ahead of time. It's possible some buyers will mandate talking to at least some employees before closing. Knowing that ahead of time, knowing what you're comfortable with, what the buyer is comfortable with, what the buyer's going to want, what you're going to want, very important. Again, give you some of my own experience. Chenmark has bought companies where we haven't talked to a single employee before closing, and others where the entire company knew about the transaction months ahead of time. And so again, it comes back to what are you looking for, what matters most to you, and what's important to you. All right, coming towards the end here. So hopefully we're going to get some good questions. Potential pre-sale red flags. So financials that need a lot of explaining, valuation based on desire, not reality, high levels of personal expense in the business, unclear motivation for sale. So I bring this up for a few reasons. Financials might not be what you care about. Maybe they're just an unfortunate nuisance that you need before tax day. And I get that entirely, but they are the bedrock of proving out what the buyer is paying for. And so if your financials need a lot of explaining, or they're horribly out of date, or they don't really reflect the performance of the business, that is going to severely lengthen the time that's going to take for you to close a deal, if you can close one at all. It is totally okay to want top dollar for your business, expected maybe even. But just like a home, if you shoot way too high with your expectations, it is possible that you will deter buyers. Again, value is perception to a lot of people. So just like stocks go up and down, values of businesses can go up and down based on a perception. And if your valuation expectations are not based in any sort of fundamental reality of your business, its size, its earnings, its profitability, its structure, other things like that, it will be hard to get a buyer to agree. Running personal expenses through your business will for sure save you some money on taxes, but it will end up costing you in the end trying to sell your business, especially if you expect to get compensated as if those personal expenses weren't through the business. And what happens there is if you run personal expenses through the business, it looks like the business earns less. For a buyer who's coming in, again, trying to understand what can this business do for me, if I have to spend a lot of time trying to figure out what expenses are real and what expenses are not, it can be very hard, and it can be very difficult to try and get to a mutually agreeable deal. And then finally, if you can't articulate why you want to sell now, a buyer may be concerned that there are skeletons in the closet. And here I'd say honesty is the best policy, and that goes for the buyer too. If the buyer if you don't have a clear motivation for buying a company, if you're a seller and it's not totally clear to you why they're interested in your business, I'd say that's a red flag as well. and having an understanding of what's the rationale for doing this and doing this now, and being honest about it is going to save everyone a lot of time. And so here's just an example of what a buyer like Chenmark would ask for in that early stage process of getting some information to try and determine if we really want to engage in a real serious negotiation and figure out if there's a real deal to be had here. And I'd sort of caveat, this might look like a lot. I'll run through each bullet quickly here. I'd say this is what I would consider to be the ante of business information. Once you get into formal due diligence, especially with a third-party buyer who's never known your business before, the information request and the thoroughness of that process is going to ratchet up fairly significantly. But this is a start. So first part would be financials, just understanding financially how your business has performed over time. For us, our typical ask is 3 years of financials, most often monthly, income statement, balance sheet, cash flow, and then tax returns, so we can tie those back to one another. So the financials of your business reflect the numbers reported on the tax return. We'll also look for a detailed asset list, just to understand the assets of the business, when they were bought, how much they were bought for, the depreciation of those assets over time, any key contracts. Now at this stage, we're probably not getting into all the nitty-gritty customer contracts, anything proprietary. We might wait until a later date, but key contracts or key leases or key agreements that are sort of fundamental to the business are good to uncover at this stage. And then an employee census and org chart, understanding who's in this business, what are their roles, how long have they been in the company, what are they paid, and understanding who's the team that helps support this business and its operations. And having this on hand at a moment's notice, or in a way that you could compile this in a few days, is going to save you a ton of time, a ton of headache, and a ton of frustration when you ultimately do decide that you want to sell. I think here we're going to ask our third and final poll question. So the reporting within field routes will help a buyer get timely and accurate information about my business. True or false? Yeah, easy one there. So absolutely, a software system like field routes sort of forces a level of institutionalization of your business into a structure that can be very helpful, not just for you to understand things about your business and help make great business decisions, but makes it much easier for a buyer who's never known your company before to understand some of those same things. It's also a great way to prove out some of your business fundamentals. And so these softwares are invaluable when looking at a small business. It's a wealth of information, and it's a very reassuring thing to see a software system like a field routes behind some of the businesses we look at. And with that, right on time. I was hoping to have about 20 minutes of questions. We're right on time. Just wanted to say thank you very much. Again, this is a very, very high level presentation, very short. There's plenty more to talk about. I hope you ask questions. But what I wanted to leave you with, if you take one thing away from this presentation, have it be this, that planning ahead will save you time and yield a better result than waiting until a time when you have to or you really need to sell right away. And a quote we talk often about is a Winston Churchill quote: "He who fails to plan is planning to fail." And that applies to the world of acquisitions, and especially on the sell side completely. If you want more information about Chenmark, our website is www.chenmark.com. We write a weekly blog called Weekly Thoughts that you guys are free to subscribe to. It's basically a short thing that comes out on Friday talking about how we think about small business acquisitions, how we think about small business operations. But if you want to talk to me directly, palmer@chenmark.com. Happy to talk to any of you. And with that, let's see if we have some questions.
Thank you so much, Palmer. You've provided some great information for us. I do already see some questions in the question and answer area. And if anyone else has any questions, go ahead and submit them for our speaker using the Q&A icon at the bottom of your screen. He's going to answer as many as he can in the time that we have left. While you're doing that, I'm going to ask that Lynn, our moderator, post a link in the chat to sign up for a free demo of Field Routes. For anyone who is not already a Field Routes customer, this is a great opportunity to experience our operations and marketing suites firsthand. She's also going to post a link to learn more about Chenmark. So let's go to our first question. What businesses have you bought? Do they share a similar service type or are they widely different? I'm more interested in expanding mine through M&A rather than selling.
Sure. So Chenmark has bought a number of businesses in a bunch of different industries. So everything from food manufacturing to agriculture to the green industries. We do own some landscaping companies and a lawn care company, which is the one that I run right now. Totally legitimate option to expand your own company through M&A. In that case, you would be considered the strategic acquirer, and you'd be buying up other companies either in tangential geographies or totally different geographies as a way to grow geographically, or maybe you want to acquire a business that does a type of service that's sort of related to your business, but maybe not something that you do explicitly. And in that case, you're acquiring that business, but you're also acquiring that competency that then you can bring into your organization, potentially use to cross-sell to your current customers or expand your service offering and be more attractive to other types of customers. So very legitimate way to grow, and very common as well.
Very good. What would it look like to sell the company to the COO?
Sure. So this would be the sort of number 2 on the list that I shared earlier about selling to your management team. And first question would be the financial capability of the COO and what you want for the business, how they value the business that they work in themselves, what they can fund up front, what they might have to finance over time. Tons of different questions to get into that I wouldn't know enough to answer explicitly, but there are definitely people that can help you, guide you through that process, especially if it's something you've talked about with your COO. It can be a very smooth transition if you've handed off a lot of the day-to-day operations to this person already, or they're running a lot of the business themselves already. That transition can be quite smooth. The question is how can you get a transaction done? Not so much how do I find someone who might buy this business if you already think the COO is interested and you think he or she is capable.
If I use the bank for financing, I assume they will want to do an evaluation of the business being purchased, or will they just use my valuation that my broker prepared?
Yeah, this one has a more transparent answer. They will definitely do their own work. The only caveat would be if you wanted to use a specific type of financing program backed by the SBA, the Small Business Administration has a financing program explicitly to help facilitate small business transactions, in which case the SBA essentially backstops or guarantees the debt. So that it sort of induces the bank to be a little bit more willing to provide financing. They will still need a fair amount of information, in which case they will do their own work. And typically what that revolves around is something called a quality of earnings, or referred to as a Q of E. And that serves as often the bedrock of financial diligence for a buyer, but also the bedrock of diligence for a bank who might be lending money against the transaction.
What factors do you look for in assessing whether or not a business would be a good buy?
Yep. So this is going to be totally subjective to the buyer. And so Chenmark as a buyer, our number one filter, because we expect to own companies indefinitely, is do we feel confident that this business and the core product or service that it offers to the marketplace is going to be in demand for decades to come? And if we feel confident we can answer that question with a yes, we'll move on. And then there's some sub questions beneath that. Does it have a profile? Does it have a size range that fits in with our model? But for us, the number one filter is is that durability of demand there? For other buyers, it might be totally different. And everyone's going to have their own take. For, one of the earlier questions was an idea about maybe expanding their business through acquisition as opposed to selling, in which case the filter might be, is this business close by and do they do the same type of work that I do? And that might be the first filter. So very subjective, but I think a buyer should be able to articulate that to a seller.
So the economy is not what it was last year or 2 years ago. Did I miss my chance to sell my business?
Yeah, so macroeconomic factors can impact certain buyers' willingness to want to buy businesses. There's no question about it. If you look at sort of the macro data in recessions, the number of business transactions falls typically. I don't think that means that no businesses, in fact, I know that doesn't mean that no businesses transact. It just means that buyers might be a little bit more cautious. It means that might be a little bit more scrupulous. It might be they are a little bit more particular, but it definitely doesn't mean that businesses cannot sell. It just means that maybe things might take a little longer or be a little harder.
Why are pest control companies selling for a lot more than other comparably sized field service businesses?
Yeah. The short answer is there are a fairly small but large, they are large group of pest control strategic companies who have adopted a desire to acquire other companies, and that is a primary method of growth. We go back to that first question of, is it feasible to expand via acquisition as opposed to selling? In the pest control space, you have a number of fairly large pest control companies who have decided that growth via acquisition is a very attractive method of growth, and they are pursuing that. And when you have a number of deep-pocketed buyers in a space, competition will work generally in sellers' favor, and you're seeing that in pest control more so than you're seeing that in other field service businesses, whether it's lawn care or pool service or what have you.
And our last question, do buyers only care about how the business performed most recently, like last year?
Yeah, I'd say it depends. Certainly last year's performance is going to be what buyers first focus on. It's the most recent history. And while history is no guarantee that the future will look exactly the same, the most recent history is going to be where buyers look first to understand where the business is today. As everyone on this webinar certainly knows, the last few years have been pretty wild. We had a pandemic which shut a lot of businesses down in the early part of 2020, and then in back half of 2020 into 2021, we saw sort of maybe to some, certainly to me, a surprising rally in the economy. A lot of fiscal stimulus, and now we're starting to see a rollover, seeing growth start to turn flat to negative. There's talk about a recession. So I would say that in this moment in time, buyers are probably going to take a much longer term view of a business's performance, probably looking back 2, 3, 4, 5 years to try and get a sense of what did this business look like before COVID and before the inflationary times, and what can I discern from that as I try and project out what is this business going to look like when things are more stabilized and not as chaotic.
All right. Well, that is all the time that we have. Thank you again, Palmer. We really appreciate you joining us today.
Awesome. Thanks for being here.
Absolutely. And thank you all of our attendees for joining us as well. We hope that you have found this valuable. Remember to watch your inbox and social media feeds for information on our upcoming growth and tips and tricks series webinars. Everyone have a great day.